Welcome to Tesla Daily News podcast on February 19th, 2026. Today we're tracking three big themes that can move Tesla stock: robotaxi execution, autonomy and regulatory risk, and the pace of Cybercab's ramp from Texas. Story 1: Tesla says the first Cybercab has officially rolled off the line in Texas, and that's a real milestone. The hook here is simple. Tesla is moving from concept renders to a physical, production-built vehicle. Here's the context. For investors, Cybercab isn't just another model. It's tied to Tesla's long-term thesis that software and autonomy can expand margins beyond traditional auto. But the market will only reward that story if Tesla can actually manufacture at scale and operate the service safely. The details. Multiple reports cite Tesla announcing the first production Cybercab unit coming off the assembly line at Gigafactory, Texas. The Cybercab is described as a purpose-built robotaxi with no steering wheel and no pedals. Elon Musk has reiterated a timeline pointing to April as the start of an initial production phase. And prior comments have pointed to an aggressive long-run ambition, a target annual capacity on the order of about 2 million units, and a customer price target under $30,000 by the end of 2026. The impact for Tesla is two-sided. The bullish angle, getting a first unit off the line de-risks manufacturing readiness and keeps the autonomy narrative alive after a choppy period for deliveries and pricing. The cautious angle, this vehicle is entirely dependent on autonomy software performance and regulatory acceptance, and the market will discount the opportunity until Tesla proves both safety and unit economics. Takeaway. Today's Cybercab line-off is a tangible proof point, but the valuation driver will be the ramp rate, cost structure, and whether Tesla can operate it as a commercial service without safety setbacks. Story 2. Tesla avoided a potential 30-day suspension in California, but only after changing its marketing language. The hook. Tesla dodged a major regulatory penalty in its largest U.S. market by removing Autopilot wording in California. Context matters here because California is not only a sales market, it's also a regulatory bellwether. When regulators push back on driver assistance claims, it can ripple across lawsuits, insurance costs, consumer perception, and future approvals. Details from coverage including TechCrunch and other outlets. The California Department of Motor Vehicles will not suspend Tesla's dealer and manufacturer licenses for 30 days after Tesla stopped using the term autopilot in marketing in the state. Related reporting notes Tesla had already adjusted full self-driving branding by adding supervised in marketing. Impact. Avoiding a suspension removes an immediate downside tail risk for revenue and deliveries in California. But it also underscores that Tesla's autonomy branding is under a microscope. If regulators constrain how Tesla communicates features, that can slow adoption of paid software, raise compliance costs, and weigh on sentiment around the robotaxi story. Takeaway. The near-term risk was contained, but investors should view this as another signal that autonomy progress has to be paired with very careful regulatory and consumer messaging. Story 3. Tesla's Austin robotaxi program has reported 14 crashes in its first 8 months. The hook. Tesla is scaling robotaxi operations, but incident frequency is becoming a headline risk. Context. Robotaxi is the multiple expansion story for Tesla. If investors believe Tesla can run a safe, scalable fleet, the business starts to look like high-margin mobility and software, not just car manufacturing. Safety performance, therefore, is not a side issue. It's the core constraint. Details. Reports citing disclosures to U.S. safety regulators say Tesla's robotaxis in Austin have been involved in 14 crashes since the service began last summer, covering roughly the first 8 months. Impact on the stock and business. Even if many incidents are minor, the cumulative count can drive negative press, trigger deeper regulatory scrutiny, and increase insurance and legal exposure. It can also affect expansion timelines to new cities. In valuation terms, anything that delays fleet scaling delays the cash flow narrative that autonomy bulls are underwriting. Takeaway. Watch two things closely: whether Tesla's crash rate trends down with software updates, and whether regulators impose operational constraints that limit geographic expansion. Story 4. Tesla is bringing Grok, the XAI chatbot, into cars across parts of Europe, and that blends product upside with regulatory risk. The hook. Tesla is adding a new AI assistant experience in the UK and multiple European markets. Context. Tesla's differentiation has increasingly come from software. A better in-car assistant can increase customer satisfaction and retention, and over time can support subscription revenue. But Europe also tends to be stricter on privacy, content moderation, and AI compliance. Details. Reporting says Tesla plans to add Grok to vehicle infotainment in the UK and 8 other European markets. Availability is tied to hardware and connectivity requirements, and the rollout is happening while Grok faces public scrutiny and regulatory attention in other contexts. Impact. If Grok materially improves the in-car experience, it supports Tesla's software platform thesis and could help justify premium pricing or subscription attach rates. The risk is that any controversy, safety issue, or regulatory finding around AI behavior becomes Tesla's problem inside the vehicle environment. Takeaway. This is a software-driven positive catalyst, but Europe is a tough venue for missteps. Investors should watch for rollout pace, consumer feedback, and any regulatory commentary. Story 5. Competitive pressure is sharpening at the $30,000 price point, right where Tesla wants Cybercab to land. The hook. Ford is openly targeting a roughly $30,000 electric pickup strategy, using efficiency and manufacturing techniques that echo Tesla's playbook. Context. Tesla's next growth wave depends on expanding volume without sacrificing margins. The industry is converging on affordability as the battleground, and that typically compresses margins unless a company has a structural cost advantage. Details from coverage. Ford has discussed a next-generation EV platform designed to be lighter and more electrically efficient, with a goal of enabling a starting price around $30,000 for a future pickup. Reports also note manufacturing approaches influenced by Tesla, like large castings and an obsessive focus on efficiency to reduce battery size needs. Impact for Tesla. The more credible the legacy automakers become at building profitable EVs at lower price points, the more Tesla has to defend share using cost, software differentiation, and charging ecosystem advantages. For the Cybercab specifically, a sub-$30,000 goal will be judged against what competitors can deliver, even if they are not building purpose-built robotaxis. Takeaway. Tesla may still have a cost and software edge, but the cheap EV window is no longer uncontested. Expect pricing and margin narratives to stay sensitive. Let's wrap it up. Today's big Tesla themes are: Cybercab moved one step closer to reality with the first production unit in Texas, California regulatory risk eased after marketing changes, and robotaxi safety metrics in Austin remain a real overhang with 14 reported crashes in 8 months. For tomorrow, keep an eye on any follow-up from regulators on autonomy language, any additional NHTSA reporting around robotaxi incidents, and any new clarity on Cybercab ramp targets or early production volumes. If you want this breakdown every day, subscribe to Tesla Daily News Podcast and follow us for the next update.